Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 103. As always, joined by the three amigos here. We got Keith Dicker, IceCap Asset Management, Rich Diaz, Tom Brady at Macro. What's going on? Keith, you got a dress shirt on today.
Yeah, I feel like I'm actually working. What does that feel like, Rich?
It feels good. It feels good. I like working. It's been an interesting few years, so working is definitely good.
Before I launched IceCap back in 2010, and for 10 years prior to that, I worked for a very small bank, a small private bank offshore. And then for a number of years before that, I worked for one of the very large Canadian banks. So you push them all together, it was about 17 years of banks and suits and ties and everything. So I like to say I got all banked out by that time. So every now and then, though, I wear a nice shirt. Oh, hey, by the way, I want to, for all of our listeners to know, this coming Tuesday, IceCap, I'm offering anyone who wants to hop on to hear a webinar that IceCap will do. So you can hear in more details our investment views on the markets, things like that. We did that earlier in the year, and we had a lot of people turn up. It was a lot of fun. But if you want to participate, just send me an email directly, and then we'll have you set up. So that will be for this coming Tuesday, and I will wear a nice shirt again for that day. How about you, Rich? You were in a nice
plug for IceCap, eh? We'll bill you.
We'll bill you.
Some shameless self-promotion, as they say. Rich, how are you promoting yourself these days? How's the love life coming along?
It's as good as German real house prices, which is to say not good at all.
Only you can come up with that, eh? Holy smokes.
You wonder why? It's been rough goes, actually. I don't know. I don't know, boys. Maybe, I don't know, something wrong. Maybe I'm not using the right Loonie Hour pickup lines. Maybe I should wear my anti central bank digital currency shirt. Maybe that would help. But no, all is well, man. I've been going to the gym a lot. I found a new personal trainer, which is something
personal trainer, eh? Times must be good.
Times are better, yes. But no, I love. It's something I've committed to. People spend money on all kinds of stupid stuff.
How much can you bench press these days?
I can do probably, I don't know, like 225 for one, I think is my personal best. So that's pretty. But Keith, you'd know this. In the combine, the NFL combine, they do like the maximum rep of like 225 pounds or whatever, and these guys doing 20. Some of them do 30. I can do one.
Yeah, the four plates is a cool. I know Steve is like pumping them out as well these days. Oh, by the way, guys, a shout out to one of my good friends, dear friends, Connor Damone. He was just named to the Canadian powerlifting team. So Connor, if you're listening today, congratulations, well done. Let's just say he's doing a lot more than one rep of the 225. Yeah, and I think that's why he has a lot of success, Rich, in the love world. So if you can increase your reps on the 225, I think that's the key.
I'll be very proud of myself.
Yeah,
I'll call you.
Yeah, well, Steve, what's new over in the land of love over there in Kitsilano?
Things are good here. I don't know, housing's slowing down. Actually, we're going to Europe next week, so we'll be traveling to Italy and to Spain. So the Loonie Hour will be recorded next week. Well, I guess we'll still be here, but the following week will be recorded in Spain. So we'll have a new background for everybody. But quick little tee up here before we get into the show. We are planning a Loonie Hour live event in Toronto in the GTA for the end of November. So anyone that's local there, if you want to help us out, particularly with like sourcing venues and caterers, that always helps because none of us are really from there, and it's always a bit of a challenge when you're moving out of the city here and trying to organize events from across the country. So if you want to send us an email, that would greatly appreciate it. If you want to mark your calendars, if you live there, we're planning tentatively kind of like a November 30th, give or take a couple days is kind of the idea. So again, shoot us an email. We would definitely appreciate the help with that. But without further ado, Keith, lots to touch on this week. I'm gonna get a little bit on the housing front. I mean, we've got some just mayhem, I think, in the bond market, confidence indexes. There's a lot happening right now, and we're kind of just waiting. This crescendo is building up. But I wanted to frame up this week's conversation around the housing fog. We've been talking about it a lot over the last couple months, which is okay. We've got the federal government, which is just getting destroyed in the polls, made worse over the last couple days here by not vetting their guests,
which we promised to do.
Yeah, we always vet our guests here at the Loonie Hour, so
We do sometimes, haven't we? I don't think we've had a bad guest at all.
We've had great guests. It's because we vet them.
We got another good one coming up here, another probably week or two. So that's going to be a big name drop for the Loonie Hour. But so the federal government's been,
it's the prime minister. Tell him he's coming on. He's going to do it.
Yeah, I don't think so. But we've had the federal government. They changed their housing minister, they changed their immigration minister. They've been doing all these things trying to get back in the polls and right the ship kind of thing. And so you'll notice, we talked about it, I think, over the last week or two, which was, okay, they removed GST on rental construction, which was like a huge move for them. It's a 5% savings to the developers. And then they've been announcing their housing accelerator fund, which for the first time in 18 months got their first sort of applicant. And, so lo and behold, we're starting to slowly make some progress. And then we had the Metro Vancouver region, so several of the municipalities just came out and said, well, we are going to increase our development charges. So basically what they're going to do is the proposed changes would increase the development charges from January 2022 to January of 2027. So over that period of time, you're going to see about a 626% increase in your development cost charges, which would add roughly about $15,000 to every single condo unit brought to the market.
And is that for the whole province or for a specific municipality?
It's for the Metro Vancouver region. So basically all the municipalities say, hey, listen, we've got all this like infrastructure that we need to sort of pay for, sewer upgrades, sewage treatment plants, et cetera, et cetera. So basically it's kind of complicated. And to be honest, I'm still like learning a little bit about how these all work, but actually just went to a keynote speech with the mayor of Vancouver, and he was kind of explaining it as well. Because he's like, this is kind of new for me as a guy that came from the private sector to learning about people look and say, oh, when your property taxes are going up every year, the city of Vancouver doesn't actually get like most of that. They actually get spread out amongst all the other sort of the region and different levels of government. So basically, the Metro Vancouver board says, listen, we're going to raise our development cost charges. It's going to add $15,000 per unit. And so effectively what that's doing is it's actually removing the benefit of the GST removal. So the federal government says, listen, we need to save developers money so they can keep building during this downturn. But then the municipalities are like, well, listen, guys, we need the tax dollars. So we're going to ramp up our fees and basically negate the benefit of the GST.
That sounds like Russian disinformation or something, man. There's no way that's true.
Stir the pot. But no, this is true. And so then...
Did you see Rich's eye roll then? He was like, oh, man.
We're 10 minutes in. We've already got conspiracy theories.
Please, can we move on? Anyways.
So anyways, we had Sean Fraser, who's the federal government housing minister. So he then came out and says, well, we're going to pull funding basically on two of the municipalities that we had just approved in this Metro Vancouver region. It's now on hold so basically now they're fighting. There's no agreement about how to do this. But this brings me to like the larger point, Keith, which is like, I think you've been pounding at home for many, many years, is like all of these levels of government, whether it's like federal, provincial, municipal, all of them are starved for tax dollars.
Yeah, absolutely. And it's, I think everyone knows now the total global debt. I think Rich, you shared with us recently, we've now exceeded 300 trillion, depending on which way you slice it and dice it up. And, ever since I was young, I was a little boy, you'd hear, oh, there's too much debt, this debt bubble is going to break. And, the 80s came, the 90s, the O's, the 10s, and it kept going and nothing ever happened. But what was also happening during that time frame with interest rates?
They were high and coming down.
Yeah, they kept going lower and lower. So now we're finally at this point where everyone is just, saturated in debt at the exact point in time when rates have troughed. They can't go any lower in the real world. And now they're going higher again. So you're right, Steve. Like everyone, they're looking for pennies in this Chesterfield now, or the sofa, depending on if you're an American or a Brit, to pay for stuff. So that we should expect this to continue. I don't know how it doesn't.
There's
I
another
know
wrinkle.
how it doesn't. We get an adjustment on the debt side, of course.
There's another wrinkle, Keith, which is not only is the debt exorbitant, it's also about like when that debt comes due and when that debt needs to be renewed. So if you owe a lot of debt and it's a long duration, liability, which is to say you have to pay back that lump sum in 30 years, when interest rates go up, it doesn't really affect you, right? But what's the problem we're having now is many countries. So I was looking at Italy last week. I was writing a note about Italy, and Miss Maloney, the prime minister of Italy, tried to, speaking of trying to raise cash, she tried to tax profits of the banks there. And on the Bloomberg machine, if you type in DDIS, you get a debt distribution. So you can see what, like over the years that are, going out until, next century, whatever, I guess, how much debt is due over in 2023 and 2024. And so some jurisdictions have made, let's say, not the wisest decision with respect to issuing that debt. And I think Italy, for example, has to refinance 364 million. No, yeah. I mean, it's just an incredible amount of money. And so, yeah, so it's not only, so Steve, yeah, it's not just the total debt. It's also when that debt's coming due, when that debt's getting rolled over. So like many households in Canada, lots of these governments are going to have to roll over this debt in the next couple of years at much higher interest rates.
So this leads me to like the continuation of the story, because it kind of just keeps getting better, right? So like, there's always like everyone's kind of freaking about the housing crisis. So we've got all levels of government kind of trying to, again, they almost need to coordinate because it's like there's so many factors that go into this. And so you have one of the ones that we've been leading up and waiting for the announcement was the BC government. So, we've already talked about the feds, we've talked about the municipalities, now we've got the BC government involved. And what they're doing is they release they call it like a naughty list, where basically they are imposing targets on municipalities. They're imposing targets on municipalities. And so what they've done is they said, okay, you need to hit these 10 targets, this list basically. And it says, gives them like a target for a number of housing completions. So not housing starts or approvals. It's like your city needs to have this many completions. And if they don't hit those completions, what they're going to do is they're going to basically start pulling funding or not giving them the tax dollars that these municipalities need. Now, the problem is while it's a great theory, in concept, the reality is that these municipalities, you can't force the private sector to build, right? So if you've got rising interest rates and an economic downturn, is the private sector going to build? You can give them all the targets that you want, and you could rezone the entire city of Vancouver right now. But is the private sector, are these projects credit worthy, and are they financially viable? And I would argue that a lot of them in today's environment are not. and people are naturally pulling back. So these
Well,
targets,
you
everybody's
could go with the Chinese strategy, a centrally planned economy, and it works until it doesn't work. And of course, with them, like, it was no miracle. It's just simply like borrowing nonstop all the time. So, like, if you give builders or anyone else like a target to hit, like you say, Steve, in capitalism, in the private sector, we will continue to produce our output as long as we're able to get a return that is expected for that investment. But if you tell us to produce more and we're getting losses on it, then we're not going to do it. So I don't know where we're in a real tough spot here, but only if the economy slows to a point where it does become a struggle. So you think about like government deficits. So I think being there in Canada was a $40 billion deficit. They're projecting.
I've got some comments on that too, but continue.
Yeah, and man, your voice sounds good, Steve. You got a real like rich.
Sorry about that, boys.
It
sounds better now.
Yeah, it sounds a lot better. I think people noticed that maybe it wasn't quite optimal. Kind of like the whole plant building, but governments, they're always going to run deficits. That's the way it is. But whenever you see an improvement in the deficit number, the first thing they're going to do is compare it to the G7. That is better than everyone else's.
Our favorite.
Right? Our favorite. But the second thing they're going to do is say it's because we're really good at doing this. But no, it's not at all. It just simply means that the economy grew a bit faster, or tax revenue collection was a bit faster, or something like that than what was expected. Governments around the world now, including here in Canada, and as well as at the provincial level and municipal, they absolutely need the economy to keep on booming and going strong, because if it doesn't, someone's going to run into trouble, and then they're going to raise their hand and say, hey, we need some help with this. And it trickles up and down the line. But that's what we see. Rich, what were you just about to say before I jumped in?
Oh, I forgot now. It's like a goldfish. My memory only lasts for about a second or two.
I've got a comment on your deficit stuff there, Keith. Because as I was talking about, the BC government here and trying to ramp up housing and all this, and obviously BC is an economy that is heavily dependent on real estate. I'd argue it's our number one industry here. But so BC, there's some updated deficit numbers. So BC's deficit is projected to jump by $2.5 billion to a $6.7 billion deficit. And so over the next, and they're on track to run a $14 billion deficit over the next 3 years. And BC's Minister of Finance says that there is no plans to cut programs or raise taxes, and that BC will ride the deficits because there is no alternative to reduce supports for people.
So there's no plan to cut services, which I believe that's the plan. And there's no plan. Of course, he's going to say there's no plan to raise taxes. So let's make a Twinkie bet on what happens with the good lads over there in BC. I'll bet you the taxes are going to go up. That's going to happen.
And this is also, Rich, you'll like this. And this is also with record population growth in this country, which is obviously increasing the tax base, right? So we did have the numbers came out revised. Remember, we undercounted by something like 1 million people. So Stats Canada's now come out with the revised figure, but Canada's population still grew at the highest rate in a single year since 1957. Mm-hmm. So we added about 1 million, just over 1 million people over the last 12 months. So it was originally at 1.2 million. It's been revised down to 1.05. So we have a 150,000 revision, but nonetheless, that's a lot of people increasing the tax base here in this country, and obviously deficits blowing out. And I think this kind of leads to probably a larger conversation, which is governments now with these deficits and huge tax burdens are obviously having to refinance this debt or roll the debt over at much, much higher interest rates. And I would argue probably falling tax base as asset prices decline and fewer home sales and whatnot.
So I have a question, Keith. Maybe you know the answer. I know I don't, because I certainly don't. But in the U.S., states are not allowed to run budget deficits. So it's like in their constitution or whatever it is. So when
they
revenues,
aren't they?
excuse me,
They
no,
are.
we should definitely check this. I don't believe they're allowed to. States are not allowed. You can Google it while I'm talking. So as I understand it, states are not allowed to run budget deficits in the United States. So when tax revenue goes down, they have to cut programs. And my question is for Keith is like, because you know more about the provincial bond market and et cetera. Are there certain like either covenants or rules around that? And how do these provinces fund themselves ultimately if there's, let's say, a buyer strike on these bonds? I mean, and again, we're not in an emergency situation, so the Bank of Canada can't go and buy these bonds. But I mean, is there like an active or a captive market in like the insurance market? Do you know what I mean?
Yeah, I know exactly what you mean. I don't know the U.S. state story, so if any listener
Yeah,
are able
it
to,
is correct. I'm looking at it right now. So the states and the municipalities in the United States are not allowed to run a deficit. Which I mean, I know the municipalities in Canada are not allowed to run deficits either.
Okay, phew, got that right.
That makes no sense because California is one of the largest sovereign borrowers in the world.
So it says the governor
Am I
must
wbut
sign
saying
a
that?
balanced budget. They're
Yeah,
prohibited from
sign
carrying
with
over
the left
deficit
hand and do something else with the right hand. Yeah,
But that's
Which
not my
hand?
question. My question is more about like how do investors and bond buyers of these instruments? I mean, how do they feel about it? I mean, are we seeing the spreads blow out between provincial and Canadian government? I mean, is these products that you would ever consider? Are your competitors interested in these products? Why or why not?
That is the important question, but I'm also interested in the unimportant question about how the state they are borrowing. I know they are like even you heard of muni bonds, right, in the US.
Yeah.
So there's definitely we'll have to go into that on another
We'll do some research
episode of the
for next
Loonie
week.
Hour. Yeah. Episode number 484. We'll dive into that a lot deeper.
Municipal taxes, episode 484. Mark it on your calendar.
We'll dive into that one. But provincial bonds, there's they're always being issued, and I think investors have to realize that you have institutional investors and then everyone else. Everyone else, it's just like us and what we manage at IceCap. Like we're making strategic and tactical changes all the time. Because we're small enough, we can do that. We can move in and out when we want, and the market doesn't care, when we do that. But whenever, just to back up a second though, there's so much money being contributed to retirement plans in Canada and the US and elsewhere. So whether it's like defined benefit plans, defined contribution plans, RSPs and all that stuff, there's net savings always coming into the system. And a portion of that is always allocated to the bond market, no matter what, because, people are sheep. They just tick that box, and that's the way it goes. And then by default, because if you're a bond manager and money comes in and you're going to get paid an extra 18 basis points for buying a provincial bond over a federal bond, there's competition for that issuance when it comes up. So during a normal cycle, Rich, provincial debt, it'll get bought up all the time. And then it'll rarely hit the market. They just tuck it away, and it's there until it matures. Now that's fine and dandy until there is a credit event like what we had back with the pandemic. And when that happens, then there's no one out there that wants to buy this stuff. And that's what happened to Newfoundland back in, I think it was maybe March or April of 2020. They just happened to be first up, the first province that had to borrow money because they had a bond they had to roll over. And I remember when it's happening, they couldn't get any buyers. There was no bid on the street. So they go to their brokers, say, hey, we need to raise this much. The broker, they put it out there and they come back, no bid. They say, well, can you do it again? I said, okay, still no bid, still zero. So then they call, Ottawa, the Minister of Finance, and say, hey, we have no bid or a bond issuance. We need your help. And they say, well, we can't help you either right now because we kind of got our own challenges. So then they go to the Bank of Canada. So that's sort of the steps, what happens. But and that's what we expect will happen again at some point soon. But that's the great setup, because it's not really shorting that market. It's understanding how capital will flow as a result of that event, because then you'll have it reflect on the currency side. But
Well,
it's
Keith,
a
that
big market.
that reminds me of another. We talk about the G7 and how it's just such a bogus comparable. Well, it also reminds me quickly about how our Canadian finance minister was like, "Oh, Canada's federal debt as a percent of GDP is the lowest in the G7." But of course, what that does is it conveniently misses all the provincial and local government debt, which effectively Canada, not explicitly, but certainly implicitly, is on the hook for. And I think that that's what you've sort of outlined why that's so.
Yeah, and just before the pandemic, the size of the provincial bond market was roughly equal to the federal bond market in Canada. Now it's a bit more lopsided again because the federal government took the debt, so you wouldn't have to. You remember that one? I like that quote. Yeah, I think Glenn asked that sort of in that interview. But anyways,
but that's the payoff. It's about 100% of GDP, basically, or maybe a little bit more now. Anyway,
yeah, cool.
So what you're saying basically is, long story short, you've got this massive debt bubble, bond bubble that is more or less imploding at the moment. We talked about the long bond down something like close to 50% from the peak and during the depths of the pandemic there. And it seems like every morning you wake up and you refresh the Bloom tubes there, Keith, that yields are pushing higher every day.
Yeah, to continue to go higher. But what's what we like? We have a view. We think we are going for recession. I mean, that's been our view. It hasn't happened yet. It's certainly happening in Europe and China, and I suspect it will creep over to this side of the pond. Rich, yeah.
Do you think we're already in a recession and you're just waiting for the data to be revised 12 months from now?
You are in Germany.
It sure feels that way.
It could be, but as they say, it's just bad luck if your neighbor loses their job. But if you lose your job, then it's a recession. So I'm not hearing of any mass layoffs at this point. I don't know if you guys are. I'm not seeing that. I just know it's not as many job hirings are taking place, what I see. And it just feels a bit more of a, I mean, for God's sakes, who the hell can buy stuff anymore? Things are so expensive. But with you go back to whether this is a bond bubble and all that. One thing that we like to watch closely are credit spreads. So that's the difference between what you and I and Rich and other people pay to borrow versus what the government is paying to borrow. The difference is we got to pay more than what the government will pay, and that difference is called a spread. For times are getting worse, or they're declining when that spread starts to get wider. And that's not quite happening yet. Right. So there's still not, the alarm bells aren't going off. But that's the next thing that you want to watch to see happen. And we're watching it closely. And once that starts to go, then okay, yeah, now we are heading over, into the darker side of the economy. But we're not there yet. But it still doesn't feel awesome though, right? Like it's not an awesome setup.
Why haven't those spreads blown out yet? Though?
I kind of know. So in 2020, when all the interest rates did fall, I can speak for the United States because I know this market a bit better than the Canada, but a lot of these non-financial corporates basically refinanced, and they refinanced at these super low interest rates. They took advantage of that, and they actually they lowered their coupon payments by about 100 basis points, and they pushed out that debt maturity.
What's the duration? Like what?
So it's changed. It depends on you're talking high yield or you're talking if you're talking high yield or you're talking investment grade. So I think the average maturity was about 6 years before 2020, and it dropped all the way down to 5 years, but it's starting to creep back up a little bit. And so, that's the thing. It's like those years are ticking away really quickly, right? So if you refinance your debt in 2020, We're already 2024. And then, of course, those are averages, right? So different companies will have different debt maturities. So it's difficult. It's unfair to use just, the average is not just a single amorphous block, right? There are different companies that are reaching these sort of refinancing maturities quicker than others, and some will have longer than others. But that date is basically on the horizon. So because there was no issuance over the last basically couple of years, or it's not no, but much, much less issuance over the last couple of years, anybody who wanted any kind of high yield product effectively was scrambling to get what was out there, e.g. that scarcity pulled those spreads in, along with decent growth and decent earnings and et cetera. But the question really is, it's sort of 2024's question, when these maturities start coming due, and much the same it is as it's coming due for households in Canada, what have you. That's the expectation, that as these high yield, less creditworthy borrowers start to issue more debt to roll it over under Keith's view that the growth is getting weaker, then you'll see those spreads come out. But until now, those spreads are very, very tight, Steve.
Yeah, so you'd say 2025 is kind of maybe a more important year, which I know for the real estate market that 2025 is the bulk of your mortgage. 2024 and 2025 is actually the bulk of the renewals.
Yeah.
You think we make it to 2025?
What do you mean, like in life, like around the sun? Yeah, I'm pretty confident the Earth will continue moving around the sun.
Oh dear.
Or risk assets.
Well, speaking of
risk assets, I'm not so sure, but the Earth, I think, will make it.
Well, speaking of government revisions, I know everybody's trying to do their best, and I think Stats Can is probably one of the worst government agencies.
I disagree with that. Carry on.
You disagree?
I just think we give them a lot of shit for something that's very difficult to do. So anyway,
we're
carry on.
back
That wasn't your point.
We're back to this again.
Oh
Come
my God, that's not the
on.
keep going.
Oh,
Keep going.
geez.
Okay, fine. We can agree
Listeners, Rich is in love with Statistics Canada.
we can agree that data collection is very difficult to do, which also makes it prone to revisions, which is a little bit alarming when you consider that central banks are, eagerly awaiting every single data point to set the price of money across the world. And so, there's a revision out today that, apparently Americans saved 1.1 trillion less than thought from 2017 to 2022. So this is from the government. The Bureau of Economic Analysis now calculates that Americans stashed away an average of 8.3% of their disposable income annually, down from a previously estimate of 9.4%. So that's about 1.1 trillion when you run the math. And we're seeing this now. And the big story kind of throughout the pandemic was, the consumers flush with cash. Everybody has so much savings. They're getting all these free checks in the mail. And so now, if you look at the updated sort of numbers here, excess savings outside of the top 20% of the wealthiest Americans, everybody has now run out of their excess savings during the pandemic. So basically what you're saying is household savings or household excess cash is below pre-pandemic levels for 80% of the US economy.
Okay, so wait, I gotta jump in here. I'm not just some simp for the stats people. I'm just saying,
Steve, you won't let it go. You won't let it go.
I'm just saying they're off by 10. They were off by 10%. They were calculating the entire savings of an entire economy over X amount of years, and they were off by 10%. It's not that bad, anyways. But the other thing, I think the more important point, moving away from the sore spot, is I think we're seeing that across the board. I think we're seeing that reduction of savings, especially on the lower income scale. So either the lower two quartiles, probably. And the way I would almost prove to you using or corroborate, I should say, is the delinquency rates. So the delinquency rates on auto loans and credit cards, especially for smaller banks, which cater to those lower income people in America, are starting to creep up basically across the board. Whereas the delinquency rates for the richer people, e.g. the larger banks, again, broad strokes, are flat. But Keith, go ahead.
Tell them how bad Stats Can is.
I'm just going to wrap my head around the whole love for the stats stuff. I think Steve's point was a lot more important than yours, but but Steve's point, again, it goes with, how much money do we really have in excess savings to spend? That's what's happening. And there's lots of different data points to suggest that there's not as much excess money available to spend. And when that happens, the only way the economy can grow on an aggregate basis is, we ought to get a raise or bonuses, or you bring more people in.
Or you
and they're
borrow.
able to work, yeah, or you borrow. And all this is sort of colliding at the same time. So whether it happens, now or next quarter or Q1 or something, again, like this is sort of stacked against the economy right now, because the only way for it to reaccelerate, we need the global economy to reaccelerate, which means the Chinese, the panda gets kicked out of the room, the Europeans, they sort things out, the Irish win the Rugby World Cup, which I think they will, and the Americans continue to do their magic at the central bank and in Treasury. So that's a lot of low probability events happening at the same time.
So just so we can summarize this, what you're saying is excess cash for 80% of Americans is now lower than it was pre-pandemic. Meanwhile, student loan payments are recommencing starting in October. And so people are kind of out of cash. So their credit card balances are ballooning, and they're starting to default on that and their auto loan payments. Yet credit spreads remain in check, and the economy supposedly is still very, very strong, and we have excess demand, so higher for longer interest rates and no landing.
Well, inflation's higher for longer partly because of the way that the CPI is constructed and the shelter component, which is still very high. House prices actually rose last week. That was on month. That was an interesting wrinkle. The Case-Shiller 20-city house price index rose. Just saying, it rose and it's making new highs. On the corporate side, corporate balance sheets are relatively clean. Margins are still high, although they are absolutely falling on the low for smaller cap companies. Non-defense airline durable goods orders surprise to the upside. I'm just saying, I think Keith's right and you're right, Steve. Make no mistake, I'm not trying to contradict you guys. On balance, there's definitely a growing number of negative data points that are starting to accumulate. But there are some holdouts here.
Hey, let's do one of those polls we do here on the Zoom. We'll set it up. And so three of us can.
Three people here.
Yeah, I know there's only three. You and I and Rich. How about we do one? We're going to raise our hands real quick. Okay. And the question is: does Canada hit a recession in the next 12 months? Is that a good question, or should it be phrased?
I think it's too obvious a question.
Steve,
no?
Steve's raising his. Steve has a question. Will you raise your hand?
Oh, I don't have a question. I raised my hand in favor.
Oh, you're voting. Okay, what's the better question then? We need something to.
We're already in a recession here.
I agree with that. I did the podcast with the Canadian investor guys, and they asked me the same question, and I answered the same. So just so people know I'm consistent and truthful in my responses, because GDP per capita has been shrinking, and it has been since for a while now. I think 4 of the last 6 quarters or whatever.
Per capita, Q2 was negative, and I bet you Q3 is probably going to be negative too.
I think the problem is you need the labor market to cooperate, and it hasn't so far.
Yeah, so let's reframe. Yeah, let's reframe it then. How about we approach the question as, do we have a hard landing in the next 12 months? Because I think a lot of people argue right now. I mean, like you guys just, hey, we're already in a recession, and it's I think it's sluggish, but we're not in a recession right now in Canada. Like there's not. One. Yeah, exactly. It's okay. I got to allocate more money for the mortgage payment and stuff like that, and there's less money left over to do things. I no doubt that is happening, but again, we don't have this people aren't lining up, down to get, to collect employment benefits and things like that yet. So the question is, who amongst the two of you or the three of us, do we hit that experience in the next 12 months? So we'll go 1, 2, 3 and raise your hand, or don't raise your. If you raise your hand, Rich, it means you agree it will happen. Are you with us, Rich?
Yeah, I'm listening. I'm thinking about the question.
3, 2, 1.
Okay, 3, 2, 1.
Yeah.
Oh man, you were like Joe Biden then, Steve. There are people who are listening. They can't see it on the on the YouTube. Back when the Democrats had their leadership race for the 2020 election, there's this famous scene. I think it has happened as well with Republicans.
Great. Tell us the story.
But I remember Biden. There was like 20 of them on the stage in this like very soft arc. And I forget what the question was. Do you remember what it was, Rich? It was
I don't remember the question, but I remember.
Whatever the question was, it was a very soft, social leaning kind of question. And you had to raise your hand whether you agreed with the statement. And Biden was way down on the end of the line. So he couldn't quite see what everyone else was doing. And so they asked the question. He very quickly leaned over and looked down the line and see what everybody else was doing. And then he very quickly raised his hand as well. I vote with these guys too. And I think the same thing happened with the Republican.
That's right.
Debate. Was it DeSantis? I think did it.
I think it was. It was the first debate, and that same thing happened.
These guys, like they're all. Oh boy.
Just want to see which way the wind is blowing, and then they'll.
Yeah, and just then we just did it, and the boomer here had his hand up right away. I think that's where we're headed. Steve looks over at the screen and sees me with a hand up. He raised his, and you're still thinking, Rich. So where are you?
So I just think so. Hard landing, I agree with. But what caught me, I guess, what makes it more challenging is whether it's going to be 12 months or not. And I think that's where I think that.
What do you think it'll be longer?
I just think it'll take a little bit longer. And I'm not trying to be like 12 months and 1 day here. What I mean is I think that just the dynamics of the labor market will play out such that it's in order to get a hard landing. I think let's qualify it. I think you need unemployment to rise by 2, 3, 4%, Keith, and to have negative economic growth. And I think that's the part where I think that's where it just takes a little longer. I think that a lot of these things play out, right? So the peak in real estate prices in the United States, just as a stupid example, was in 2006, but it took a year and a half for Michael Burry of, Big Short fame to be proven right on his trades, almost 2 years. And so I think that's where sometimes we conflate sort of the sentiment with sort of the data finally corroborating. And so that's why.
Yeah, that's fair. I think what we can say, I think, correct me if I'm wrong, but I think we can pretty confidently say that like almost every aspect of the economy seemingly peaked in like February, March of 2022.
Yeah, that's
I can tell you fair. For housing in Canada and the US, that was like the tippy top was February, March of 2022. And so since then, it seems like it's been a slow grind, like lower or weaker. And
Steve, you realize you and I did commit the cardinal sin, and Rich didn't fall into the trap. We made a prediction with a timestamp on it as well. You never do both, by the way. You either say something might happen, you're not sure when, or you say by this time something might happen. You never say what that something might be.
Well, what do we know? We're basically, so since like the economy, I argue like the global economy effectively peaked in February, March of last 2022. We're like 18 months into a slowdown.
So yeah, that's actually a good counter to my point.
So I think we're already right then. We're already right. We don't even... Of course, the obvious question is will the Loonie Hour still be around 12 months from now anyway to collect on this?
We might get canceled before then. But I wanted to throw something, give you guys a point, which is the one data point that came out today, I think, is the Canadian Federation of Independent Businesses. I got it. Oh. CFIB, which is really cool. It has a great sort of it's a survey basically of independent businesses naturally, and they ask all kinds of questions, and they had a decline in their main economic indicator, of which we've only seen 4 times before. So it basically fell to 48 or whatever. I'm trying to dig up the damn number. I can't seem to find
It's
it.
on Keith's Twitter. You stole his tweet.
Oh yeah, that's right. I stole your tweet, Keith.
Yeah, I was pretty. I'm never that fast with doing anything really. Like my friends and family would tell you, but I was pretty swift this morning to scoop that out from Rich.
But it's amazing, and it's it's a huge number, and that number hasn't been as that low since basically the pandemic or the government shutdowns in reaction to the pandemic, and so it's quite a remarkable number. Now it is volatile, so you have to be careful. Again, never never cheer yourself on after one data point here, but it will be interesting to see how this sort of evolves. And naturally, within it, obviously, you have to look at sort of the components: capex spending, hiring and firing, inflation expectations, and all that stuff.
Well, to that point, consumer confidence in Canada as well, I think came out a couple days before the business survey there, and that's also at its lowest levels outside the pandemic. I mean, we're getting close to the depths of the pandemic, so Canadian consumers aren't very confident at all, and businesses appear not very confident either. So, I think both of that will probably lead into spending, or as you would say, capex. If you're going to start investing in your business, how confident are you going to get? Over the next 12 months, you're going to get a return on that investment. You might want to stockpile some cash for a rainy day. So, I think that ultimately probably leads us lower, Keith.
You know what? He's looking at his Instagram.
He's sleeping.
I don't have that
Sleepy
one.
Joe.
I don't have that. I do like a nap every now and then. I do admit that. There was one of the followers we have of the podcast on Twitter sent us a question or an observation they had, which I think is quite interesting. And let me see. I think it's the right one. Oh yeah. So the question was, are we following? We have any thoughts whether we see a developing or looming social crisis when it comes to retirement in Canada, considering the current backdrop? And it's sort of referencing there was a note that came out that it shows in the U.S. that the percentage of U.S. homeless for people over 50 years old. So in the 90s, it was 11%. In 03, it was 37%. And then 23, it's 50%. So I find that hard to believe, but 50% of people older than 50 are homeless. Again, that
sounds wrong. That doesn't make any sense.
Is that
it's on the
Stats
internet
Can again?
It must be true. But
Stats
I think
Can.
if you ignore the number, maybe it's just people getting older or whatever. But the question is interesting. So let's have a talk about that. Obviously there's the homeless crisis. It is accelerating in Canada. We see it everywhere we go across the country here. And I'm not seeing a lot of solutions from it where I am here and we travel elsewhere. But is it the older part of the population that's more at trouble here than younger ones? Because if you're older, maybe you have less opportunity to continue working or to get a job again. I think one of the big risks is if they're holding a lot of bonds in their investment portfolio, that gets mullered, tongue in cheek, but it's absolutely true. But I just thought it was an interesting, perspective that was brought up. So it's basically our older people at trouble here if we do get a hard economic landing. Does that make sense or no sense?
Yeah, that does. Go ahead, Steve.
Well, I think I've been observing it for a while now. I kind of play into the fourth turning thesis with Neil Howe. But I feel like society is definitely breaking down. I think the gap between the haves and the have-nots. I think it's really just been the debasement of money particularly over the last couple of years, but over the last decade, you're just seeing it getting worse and worse and worse. And I think you look at all these stores being looted in parts of the US, the homelessness that's getting worse and worse in cities like Vancouver, Toronto, more glass being broken, more violence. I just think that's just society breaking down.
I think it's just to jump in, I think it's a good, like, I'm glad this question was asked, because normally, like, we talk about the economy, whether we're growing or we're not growing, and stuff like that. But in my mind, I'm not thinking about seniors. I'm always thinking about, the 30-year-old who's working really hard, and the 40-year-old, and pre-retirement. So I think it is, we don't have a solution for it, of course, the three of us here, but there is an older generation, even though they may not be working right now, but they are going to be, feeling the stress if we do get a hard turn down here, and it maybe their rent goes up and stuff like that. But I think it's something that all of us as Canadians or families, we call your folks and your aunts and uncles and grannies and stuff. Make sure everyone is okay here.
I think we have to be careful, though. Number one, that number is wrong. 1 out of every 2 people over the age of 50 is not homeless. So there was something.
It sounds like one of those.
There.
It sounds like one of those surveys where they say every Canadian is $200 away from being bankrupt, and and they've been saying it for 13 years.
Let's not focus on that specific number. I just want to be very clear about that.
Well,
that
it's a number, and it's on Twitter, on the internet. So
it must be true. But I think the key point is the vulnerability aspect, and I think we should absolutely address that. And people say, why? Well, because a lot of these people are on fixed incomes, right? Either a defined benefit pension plan. I'm sure some of them are on defined contribution plan. Okay.
Can't read that, Keith.
I can't read that, Keith.
It's actually Wall Street Journal.
But it can't be half, and I can tell you. But just anyways, let's not. That's not the point.
Yeah, let's not worry about the number.
The number. It was really about sort of the vulnerability these people have, and a lot of them are on fixed income, and which is why inflation is so pernicious. I mean, as far as the society breaking down thing, I think we need to be also really careful about, because, in the 90s, just using American statistics, I mean, murder rates were double what they are now. So, like, yes, we've seen a tick up in violent crime basically across the board, on all kinds of different but we forget what it was like in the 80s. And I think it's important to remember we survived that, and, we'll probably survive this. And I think we often sort of, whether it's different scientific issues that people are arguing about now, or societal issues, I think we overestimate the importance and acuteness of the hardship in a recent history rather than sort of having a historical context. I think that's what happens all the time.
Very good point. I think you're always the good balancing act here.
But I think the key's point is about, like, these fixed income products. These people who are on fixed income, I think, are absolutely getting squeezed, and in some cases killed. I mean, if you retired, 5-6 years ago, and you're taking a $1,500 pension, I mean, that $1,500 is not going anywhere near as far as it did, let's say, 4 or 5 years ago. And we don't think about that enough. And I don't know what's going to happen. In the UK, for example, there's something called a triple lock. And a lot of these pensioners sometimes basically have the minimum of RPI, CPI, or whatever, or like the average wage growth. I can't remember exactly the 3 things, but effectively it guarantees sort of that pension sort of payment from the government in real terms. And in Canada, that's absolutely not the case. Well, I think we also need to be careful, though, because baby boomers have the lion's share of the wealth and the assets in this country and in the US. And so I don't really feel that sorry for them, I guess, is what I'm trying to say.
You see that? He doesn't feel sorry for the boomers.
I don't feel sorry for the boomers.
Do you have not even empathy?
Absolutely not. No, they rode interest rates from 20% to 0, and everybody thinks they're an investment genius. And they have no. I don't feel sorry for the boomers.
He's attacking you and your big house.
Oh, boy. Next thing you're going to say, the Canadians weren't that good in the 70s either. So
there was only 6 teams.
Oh dear.
Oh dear. Now bring on the comments.
Like you said, Rich, like you joke about, you're going to be alone for a long time.
Hey Keith, while he's on this tangent, while we got Keith going, or while we got Rich going, why don't we just keep stirring the pot? To kind of round out the show here, there was statistics from the Bank of Canada, which
My
said,
favorite.
the carbon tax. Carbon tax applies something like 0.15% to headline inflation. So it contributes to inflation, but for the Bank of Canada's own research, maybe not that much. And of course, there's people going around Twitter and saying, see, it's it doesn't really inflate that much. So it adds 0.15 percentage points. However, the food professor who's on Twitter, I don't know his actual name.
We should have him on though.
Yeah, we should have him. Dr. Sylvain Charbois.
Yeah, I think he's down here at Dalhousie University. So,
Yeah, he's down.
We should get him on as a guest. Absolutely.
So yeah, he's known as the food professor. So he actually emailed the Bank of Canada and he posted the Bank of Canada's response, where he basically asked them, he says, well, can you tell me how you've calculated the 0.15 percentage points? And so the Bank of Canada's response, I'll summarize it, is they said, the estimate applies only to the direct impact of the carbon tax on those three products that are included in the consumer price index: gasoline, heating oil, and natural gas. It does not attempt to capture any second round or pass through effects. So again, just so everybody's aware, the Bank of Canada, when they're measuring how much the carbon tax adds to inflation, they're only including basically what it contributes to gasoline, heating oil, and natural gas. Nothing to do with pass-through effects, aka if the trucker's paying more for his diesel to truck your produce across the country, they're not factoring in the fact that the trucker's probably going to have to charge higher rates to feed them. You're the fertilizer that the farmer uses to grow the crop, for example. Anyways, we can go on and on and on. But that's, there you have it, Rich.
That person deserves an F because it's something, yeah, of course. Well, you said they're not, they might pass through. They will pass through. That's absolutely.
Well, basically, the Bank of Canada said they don't calculate. I guess they probably don't even want to be bothered by trying to do the math on how to even calculate that. But clearly, I think anyone with a
brain,
a brain, anyone that's past third grade could tell you that there's going to be obvious pass-through effects.
So I think this will be a great conversation. We will invite him to come on, and by the way, like, so his the Twitter feed is the food professor.
It is the
It's a good
food
follow,
professor.
Yeah. So one of somebody I know in my network, they actually know this guy as well. We'll have him on. But whenever I see the Twitter feed, I always read it as the food processor. I can see like the big blender, mixing it all together.
He's definitely not coming on the show now.
Yeah, well, usually Rich says those kinds of things, right? To scare people away. Okay, so we got almost the end of the week here. What's the big market movement that you guys have seen that is really catching your attention?
Rich, you go first. Today it's the bond market. I mean, market move or market catalyst. I mean, United Kingdom bonds are down 13, or sorry, excuse me, bond yields are up 13 basis points. The whole European space, yes, on the day, and it was higher. At one point, it was like 16 or something.
What's going on over there? 13 basis points in a day. That's nuts.
It's a lot. So basically, everyone in Europe is up 10 basis points, and I know that doesn't sound like that much. Like 1/10 of 1%, but for bond yields, that's a lot. So getting mullered basically. Yeah, I think it's this higher for longer. I think the whole yield curve is basically catching up to basically the Powell's view that they're not going to cut rates. So that's the thing that's interesting to me. Keith?
Yeah, I'm watching oil markets quite closely here. Oil continues to march higher. It's down, today, but it's down from yesterday's all-time recent high, if you want to look at it that way.
What are we at, $95?
Right now on WTI, 92.5 on the November contract, to be precise. But it is, for the economy and equity markets have been coming off the last few days and all that stuff. If oil comes off, then that will provide a bit of a cushion here, for markets to bottom and rebound again. But everything now is just refocused on the whole oil trade as well. And what's interesting, Canadian dollar, some days is trading with oil, other days it isn't. But if we get oil coming off here now, then you could see CAD coming off with it as well. But keep watching. Remember, every single market affects each other. You got all these interconnecting lines taking place. Nothing's going to move in isolation. But that's about it here from our end. Yeah.
I've got so over the last month, the Canada 5-year bond is up about 50 basis points. That's pretty much all getting passed through to mortgage rates here over the last couple of weeks. So your 3-year fixed mortgage rate, which is, again, I'd still say the most popular product that Canadians are using today, gives them enough sort of peace of mind. The rates are kind of in that sort of sweet spot. So your 3-year fix is about 6.5% today. So again, you're getting stress tested at 8.5% if you want to make a real estate purchase. And I think the housing is slow. And it's taken a pretty abrupt shift lower over the last 4 weeks throughout September, which again, September is supposed to be a seasonally busier time of the year. And
is this lower in say the GTA as well in other markets, or just
so GTA is the worst market for sure. I would say Vancouver's slow. It's not doing great right now. The listings are sitting, sellers kind of holding on prices, maybe slowly cutting. But GTA is the worst. You're hearing lots, particularly in the suburbs. Obviously, Calgary market is still performing well. So, there's always regional differences, but in general, the GTA makes up sort of large chunk of the national statistics and the national home price index, that as the GTA moves, that number will move. And so I think you're going to see, again, with rates at these levels, it doesn't work. And
what about in
sorry, it's going to be a challenge the back half of this year, October, November, December. There'll be some good buys.
What about in the Maritimes? Because I know, during and sort of directly after COVID, we saw some huge price rises in Halifax and Fredericton and all these little sort of tinier cities. Has that come off a bit, or?
I think a little bit. I think basically it's like almost like the more it went up, the more it's kind of coming off.
Okay.
So those areas are coming off. I just had some clients relocate from Ottawa, trying to sell their house, told me it was a battle, a couple price reductions to get it moved. So, I just think that's the general nature. Like, again, I think sometimes we like overcomplicate it. It's just like, listen, like mortgage rates at 6.5, if you're going to go shorter term, right? 1 year, a 1 year fixed is like 7.3.
Yikes.
A 2-year rate is like 6.8.
Well, to let everyone right now, the market has the Bank of Canada they've already peaked with raising rates, and right now they're showing the first rate hike. I think it's for July of next year.
Rate cut.
Rate cut. You mean?
Rate cut. Yeah. What did I say? Rate hike.
No, we got you. We got you.
So
yeah, I didn't. Just to be clear, they're not gonna raise rates anymore, and the market is pricing for a rate cut by July of next year. So that's what's
to your point, Keith. I'm anecdotally just having a few more conversations with mortgage lenders, brokers, and you're starting to see a little bit more take up now in variable rate mortgages. That the product was basically extinct over the last 12 months. And now you're starting to see some Canadians saying, okay, well, maybe they're probably done. And if the market is pricing in or expecting, even 1 or 2 cuts next year, because you can get a variable today at like, about 6.5%, call it, which is like the price of your 3-year fixed, right? And so most people are like, well, if I want a 2-year, I can be like 6.8, or I can just take a variable at 6.5, hope that they're done. Or even if they go up another rate hike, that takes me to 6.75, and maybe they're cutting next year. So the variable product is starting to get a little bit more take up now. And so it'll be interesting to sort of see how that shapes up over the next 6 months or so. But again, even if you go, 5-year fixed rate, nobody wants to lock into a 5-year rate, right? Because it's the highest rates in 15 years or something like that.
You don't want to be that guy.
Yeah, your 5-year fixed mortgage today, if you locked it in, you'd be looking at about 6.1, 6.2.
Crazy.
So it's like, do you want to lock in for 5 years at 6.2? I mean, there's definitely a lot of doomsayers out there on Twitter that will tell you it's going to 10.2, but
so it is a struggle then, for people in that space.
Yeah.
I have to get moving along. So I got 2 things to finish with. One is just a reminder that if anyone wants to attend or participate in a webinar that IceCap is going to do for Tuesday, just send me an email and we'll be sure you get invited. And then the final thing is now our weekly tradition. We get our football score prediction, right? We're having fun with that.
You're doing really well.
Yeah, I know people like that. So the San Francisco 49ers are hosting the Arizona Cardinals this weekend. Generally, you don't want to bet on football until after the 4th week. Then you can establish, what teams are doing and stuff. It's probably be kind of close during the first half. They feel each other out. But the second half is going to be different, Rich, because that's when you figure everything that's happening. So the final score, I had the 49ers winning, scoring 34. And Arizona get a late field goal. They give themselves 9 points. So that's 34-9, Rich. You bring that one to the bank.
This guy never predicts a loss. You forgot the third point.
You're like the Bank of Canada and the rest of the statistics houses. You never predict a recession in your own team, eh?
I know, like you always go undefeated. So we see where we go. But that's what this week is looking like.
You missed the third point.
What was the third point?
Say no to CBDC.
Oh yeah, say no to CBDC, of course.
Yeah. Oh, by the way, a special hello to a Loonie Hour listener, Mark, over in Cape Breton, Nova Scotia. I had a nice chat with him earlier this week. He's been listening to all the episodes, and he tells all his friends about it, and that's what we love about the community here. So, hi, Mark. Thanks for listening and tuning in.
That's a wrap. As always, appreciate the support. Thanks as always. If you're in Toronto, we'll hopefully see you towards the end of November. But either way, we'll see you next week.